Hey, good morning, everybody. Kenny here, and today we're going to go over a quick morning minutes again. And so the futures market looking really sloppy here, very deconstructive on the charts. I think technically we might have seen some damage to the charts for sure. So the NASDAQ is probably a little bit resilient here, negative 0.69%. Still red though, but the VIX screaming 24.50, bright green here, plus 10.34%. So not the recovery we wanted to see. Crude oil and Brent also under pressure here, 67 and 70. The only thing that's really up on the futures market, orange juice and lumber, which, unless you're invested in orange juice or lumber, not really good for the overall markets. That speaks to market breadth as well. We'll talk about that in a second when we break down kind of the technicals here. So it's a technical breakdown. Overall, there's plus 1% bounce in the U.S. Equities market, but breadth still negative. If you don't know where market breadth is, it's essentially, how many kind of sectors are participating in a rally, or what, sectors or market caps or whatever it is, however you kind of make that universe of stocks and bin things, right? But really the only kind of sector that showed strength, at least for us, in the kind of charts that we monitor, were tech. And even tech, some of the names didn't rally as hard as we would have liked. So from what we see, momentum still looking very negative. We got slope MACD, and the RSI was not oversold on the daily. And you're wondering, hey, Kenny, why are you talking about MACD and RSI where you never talk about those and you don't really like those? I do take a look at things that other folks are looking at when necessary, especially when it comes to kind of like offsides positioning. And if you don't know what that means, essentially, going into a Christmas rally, if you're offsides, it's going to be problematic. It's going to give you more room for a bigger rally. I kind of thought yesterday might have been that moment, that opportunity, but it didn't look like we rallied hard enough. And so right now, for what it's worth, we think that we're in no man's land. We still might get a rally at this point, but I think it might be a late rally, erring on the side of caution here and kind of being contrarian. So I don't know that the rally is still intact, but I'm thinking it is. I'm not discounting it yet, but if it is, it's going to be late. And maybe late this week, early next week, which is still pretty late. But, that's probably fine given kind of the things that we're seeing with the Omnicron variant and those kind of things as well. So Jerome Powell told the Senate that the Omicron variant poses downside risk to the economy, and it also complicates the inflation picture, meaning it looks like the Fed is going to be what everybody calls dovish. If you don't understand that, that's just simply saying that, the Fed is going to probably be a little bit more relaxed in kind of how they approach the markets, and kind of giving it a little bit more of a tailwind for at least the short term, right? Long term, obviously, we don't know what kind of damage that does to the market when you have this quantitative easing and all these policy measures in place to kind of keep the markets afloat. So here's just the quick notes here. So Fed Chair Jerome Powell believes that Omicron rise in coronavirus cases pose a major threat to the U.S. economy. Worries over the new variant could reduce people's willingness to work in person, which would slow progress in the labor market and intensify supply chain disruptions, he said in the prepared remarks. So it looks like Janet Yellen, the Secretary Treasury, and Powell are going to meet Tuesday and testify before the Senate Banking Committee. So we'll see more then. So be prepared tomorrow. I'm not sure what time it is, but if it's during the markets, which I assume it will be, just be prepared. Hopefully we get something that's good, because the markets are not looking real nice right now. So Americans should expect to see surges over Thanksgiving, Christmas, and New Year's, and this is from a September article from the New York Times. But really, I just wanted to say that, some folks are forecasting, or were forecasting, that the Delta COVID variant would be, which is like the fourth wave, would be finished up by January/spring. This is saying spring. This is probably one of the more aggressively kind of bearish kind of forecasts, but it looks like they're saying next spring. But just remember, the one thing that I want to say is Delta variant now accounts for 99.5% of the cases. And so, if you really think about this, just think about it. Like, if it wasn't for the Delta variant, this thing would be actually kind of over. Omnicron, of course, but you get my point. So, as these kind of variants kind of spread out, who knows? I'm not going to play virologist here. I'm just thinking out loud and just kind of thinking through my case as well. Just kind of think through what could possibly happen and how it would affect the markets. But anyways, if you look here, just still monitoring it. And again, I hate to say that we're still monitoring this right now, but if you look here, Germany was doing the crazy up thing, parabolic. But if you take a look at this new chart, it looks like it's starting to stabilize a little bit. So the weekly caseload didn't go up from here, still sitting at around, it looks like, 700 per million people. So, I mean, that's a little bit of a sign that maybe we've stabilized a little bit. So, yeah, just a thought there. But here's ICU beds. And so this chart looking at obviously Netherlands and Belgium under the most pressure here, had the most case counts. But looking at ICU's beds, UK is doing pretty well, in fact. And so, this is kind of a little bit optimistic. But yeah, for the most part, still trending up for a lot of these countries. And so this is a kind of, I guess, a scatter plot versus bar chart. No, not scatter plot. This is just a bar graph, which is kind of showing futures market pricing against what the economists are forecasting. And it's kind of very hilarious and funny because if you look at this, the futures market pricing is just pretty much telling the economists that we don't believe you. And so, they are definitely thinking that these rate hikes will come sooner rather than later. Just a thought, if the market is efficient, then the futures market is just not believing the Fed. This is what they call a say-do gap, meaning you say something and you do something else. So really quick kind of narrative on oil here. So JP Morgan published this article, but Global Energy Supercycle 4. OPEC show me the barrels. Anyways, our proprietary analysis reveals that OPEC Plus is not immune to the impacts of underinvestment analyzed over a period of 18 months in our supercycle thesis. We estimate that true OPEC spare capacity in 2022 will be below 43% below consensus estimates. That's huge. While we believe a 3-month pause in 400 kb monthly increments is needed during the first half of 2022 to balance the market and potentially cut impact from the new COVID variants. The basic gist of this entire article is essentially saying that, OPEC is not immune to the impacts of the CapEx deficits. And so, they also have this chart to kind of go with it. Take a look at this chart, though. And so, ESG pressure against all the majors in red. So in red, showing a very, very monumental decline in kind of rig count here. But look at the kind of private market, right? The private market says, okay, if you're going to have oil at $80, we're going to play and we're going to turn up the heat. But how big are the private ones compared to the majors, right? And so this is just kind of suggesting that, OPEC still in control, it's still in the driver's seat. And the private kind of rig count is the one that's kind of bailing us out in terms of supply. So, I mean, this is definitely something that you want to take a look at. And, we're cautiously optimistic on the oil trade still, only because we do think that there's a major catalyst coming up. So a long-term play, not swing trading really here. It's almost like an investment in the next 3 years, waiting for that catalyst to kind of play out. So just comments really quick again at the end of the day. So just to finish up this morning wrap up. So we got some comments here from Nefateria, sitting here wondering if I should sell, and every time I do I regret it, so I'm going to hold a few shares. I bought at 38 and going average down. It made a lot of sense, and you can't really find Jamia videos. Thank you for your content. Yeah, thanks. Yeah, the thing is, you just got to do your own research and due diligence. I talk about this all the time, but essentially, the reason I say you have to do your own research and your own due diligence is because, if you don't, you're not going to feel confident holding your positions. And the ones who feel the most confident, and for good reason, usually just don't regret it. It's kind of one of those situations. It's going to sound really funny, especially in a morning show, but you love deeply and all that stuff. You just don't regret it at the end of the day, even if you broke up with them, right? Even if the company goes bust or whatever like that. That's just kind of some of the luck that happens in life. But as long as you think they're doing a great job and you tried your best, then the relationship should be fine. Anyways, Pulf says, why short when you're a major support? This is for the Tattooed Chef. There's so many different proprietary metrics that I use that make me have to take this trade. The Tattoo Chef is part of this kind of macro thematic trade that I'm looking at. That's one. Two is I did get this comment a lot, so I kind of want to clarify and justify. I don't have to justify it's my trade, but I'm still going to do it. It's at major support. No, I'm not an idiot when it comes to the technicals. Major support, you think so, but even if you do consider this major support, this line, and that's the actual reason why I'm taking this short here, because if so, I'm seeing a lot of weakness at this major support, and if it breaks through this major support, I get a big gap down kind of contrarian move. And so, I don't think that that's priced into the options. So that's one. And so if we do break down and we do break down through this, asymmetrically, it's going to be a move. And so that's what I'm betting on. Yes, it's support, but if it breaks through, big move to the downside, which is what makes it asymmetric. Anyways, Joe says, I'm still not understanding the early stages part. Essentially, Jamia doesn't know what it wants to be when it grows up. You start as a little baby and you try to find your way and you figure out you want to be a mechanic and then an astronaut and then a soldier and then a doctor. Unless you're like an old boy there, you can't be everything, right? So still trying to figure out what it wants to be, still not profitable. So that's kind of where I was when I was trying to break down Jamia. Anyways, 11 minutes, a little bit long today. Thanks for watching, and we will see you tomorrow. Bye.